Silver closed today over $28 with a setup for a cup and handle formation. The Fed said Joe Biden's full of crap, this economy sucks, and schedules some quantitative easing for June. There's a lot of activity out there, so let's jump into it. In fact, there's so much going on, I had to go take a walk today. So silver closed at around 28.13 today. I was looking at the day chart on Kitco. And by the looks of the chart, man, it looks like it climbed and then took a beat down, and it looks like it bounced up and then dropped a little bit some more. And normally that'd be a pretty depressing thing. But once I elongated the timeline, I realized that this isn't a bad thing at all. Check this out. You see, on April 19th, it reached 28.74. And then again, just today, it hit 28.74. And in between the two, you see that bowl shape right there? Yeah, that's a cup. And then it dropped a little bit. It's dropped a little bit. And on a long enough timeline, that would be a handle. And that's an indicator that silver is going to move higher. Hopefully, since it's close enough to 30, it can break that glass ceiling. If the price breaks $30, I don't remember the last time it's broke $30, but I know that it's bounced off it a few times. Once it breaks it, it'll go even higher yet. And then I believe $28 will probably become resistance for the bottom. It'll have a new floor. So that's interesting and a little exciting. So the Fed announced that they're going to have some quantitative tightening starting in June. Meanwhile, Biden's still singing the song that this economy is so great and he made all these jobs, when the truth of the matter is that the job growth was like 1%, and a majority of those jobs were part-time jobs in the service sector.
Yeah, I guess I can't really talk. I don't get it. I don't know what they're talking about.
So the Fed's saying one thing, the president's saying another.
I don't think there's anything confusing there.
And although 1% of job growth is a good thing, it's really not. It's not anything when you're dealing with inflation, especially if you've got low-paying jobs that you're producing. So I remember quantitative easing. I've never heard of quantitative tightening, and if you haven't, it's okay. So the Fed is going to slow the pace of balance sheet runoff. Central banks to lower Treasury runoff cap to $25 billion from $60 billion, and this reduction is larger than market observers were expecting. Well, that's great, but that begs the question, why didn't they just cut interest rates? It would have done the exact same thing. You would have had the same outcome, right? Well, quantitative tightening is a way to get the same results of an interest rate reduction, but it's not an interest rate reduction. But here's the thing. All the other countries around the world, their central banks are cutting interest rates. And if we would have cut rates, it would have spurred housing development. Housing development means there would have been more houses. It would have lowered the cost of houses. It also would have lowered the interest rates, making it easier for first-time home buyers. If we're under the assumption that the reason why home prices are exploded is because of supply and demand. But we didn't do that. Could it be because the Japanese yen is in trouble? What's that got to do with the U.S.? Well, just so happens that Japan owns, they're the largest holder of U.S. T-bonds. And the yen has been in trouble for a hot minute. But recently, their central bank stepped in 3 times in rapid succession trying to bail it out, like a quantitative easing, and it had minimal effect, and it keeps falling. And if we lower our interest rates, chances are they're going to sell our T-bonds, our bills. And that is going to send hyperinflation crazy. It ain't going to be good. So I guess the quantitative tightening is like a controlled fall, right? So we can expect inflation to continue, but in somewhat of a controlled manner, I guess. I guess that's what I'm supposed to get out of it. I'm not sure. You guys leave a comment below if you got any insight on this. So I guess in a way, we're kind of in a catch-22. Pick your poison, I guess. But on a lighter note, channel's growing. I've got new subscribers and new viewers and all kinds of comments, and it's motivation. He says, I like gold as a good hedge against inflation and contributor to my superannuation savings over here in Australia. I think you guys in the USA call them 401ks. Initially, I bought 1 gram as well, but have moved on to halves and wholes. Thank you, motivation. Lauren T. Gage says, great stash. I don't know where silver or gold will go, but I think having a good stash and some days stack would make me feel much more secure in these rocky times. Congratulations on your gold. Thanks, Lauren. Kella Nicole, 86. Very cool. You're very cool, Kella. She helps me with my editing sometimes. Thousand Air Radio. I see you were keeping them coming. Good work. Well, thank you, Thousand Air. Mickey FC commented, lovely bar, Patriot. Can't go wrong with diversifying the stack. I totally agree, Mickey FC. Thanks for watching. Tuli Tuli replied, beautiful gold. Thank you very much, Tuli Tuli. Jace Thousand Air Collectibles replied, thanks much. I appreciate it. I subbed your channel this morning. Great content. And he's not the only one that's subscribed. Arthur's channel. He subscribed. Thanks, Arthur. Welcome, Bob Wojciechowski. Pleasure. And then we got Emerald Coast Stacker in the house. And we got the Southeast Stacker. And, of course, Tuli Tuli. She subbed also. I had a lot of subs. I got slammed. I want to thank all my subs and all the viewers. I really appreciate. I feel I'm building a great community. I've got some of the best and the brightest as far as I'm concerned, and I really want to just say thank you. And if you're new here, hey, sub, leave a comment. I'll give you a shout out. Well, that's all I've got for today. I want to thank everybody for watching. If you made it this far, leave a comment, sub, hit the like button, and I will talk to you later. This is Steven, and I'm out.